let's talk about a single 3-digit number that, whether we like it or not, pretty much controls our entire financial life. I mean, it decides if you get that car loan, what interest rate you'll pay on your mortgage, basically what financial doors are open to you. We're talking, of course, about your credit score. So, what is this magic number that has so much power? It's not about how much is in your bank account, and it's not your salary. It is your credit score. And for so many of us, there is one major thing that's constantly, day in and day out, working against it. And you might not even realize just how bad the damage is. And that one thing, it's your debt. It is the absolute silent killer of a good credit score. You might think you're doing everything right, making your payments on time, but the sheer amount of debt you're carrying could be secretly dragging your score down into the mud. So that's what we're jumping into first, your score's biggest enemy. We are gonna pull back the curtain on all of this. We're gonna demystify how your credit score actually works, see exactly how debt wages war on it, and then we're gonna lay out a clear battle plan to fight back. But here's the good news. This isn't some crazy, complicated formula that nobody can understand. The best way to think about your credit score is like a report card. That's it. It's just a grade on how you handle your debt. And once you figure out how you're being graded, well, you can start acing the test. So let's crack that code. Your entire score is built on just 5 main components, or pillars. Getting a handle on these is seriously the first step to taking back control. Okay, so take a look at this. This is the whole shebang right here. What's so important is how much weight each piece has. Payment history, did you pay your bills on time? That's the biggest chump at 35%. But look what's right behind it at a massive 30%. Amounts owed. That's where your debt really comes into play. After that, you've got length of credit history, new credit, and credit mix. But just look at those first two again. And this is the key takeaway. Payment history and amounts owed. Together, they make up 65% of your entire credit score. That's almost 2/3. So if you only have the energy to focus on a couple of things, it has to be these two, period. Paying on time and managing how much you owe. Now let's zoom in on that amounts owed piece, because this is where you can make the biggest and fastest improvements. It's not just about the total dollar amount you owe, it's actually all about a ratio. And understanding this ratio is your secret weapon. And that secret weapon is called your credit utilization ratio. All that means is it's the percentage of your available credit that you're actually using. So, say you have a credit card with a $10,000 limit and you have a $2,000 balance on it. Your utilization is 20%. To lenders, a high ratio looks like you're stretched thin, like you need all that credit to get by, and that is a huge red flag. This example shows it perfectly. Look at Sarah and John. They both have the exact same amount of debt, $2,000. But Sarah has a $10,000 limit, so her utilization is a nice healthy 20%. John, on the other hand, only has a $3,000 limit, so his utilization is a sky-high 66%. Even with the same exact debt, John's score is getting hammered because his debt is way too high compared to his limit. So what's the magic number you should aim for? Well, the standard advice is to keep your utilization under 30%. But here's a little pro tip for you. The folks with the absolute highest credit scores, we're talking the 800+ club, they consistently keep their utilization under 10%. That's the real gold standard. That signals you are in total command of your finances. Now, it's really important to know that not all debt is created equal here. Revolving debt, that's your credit cards, is what really drives this utilization ratio. High balances on those are an absolute score killer. But installment debt, like a mortgage or car loan, is different. That has a fixed payment, and paying it on time every time actually shows responsibility. So the debt you really have to attack is that high ratio credit card debt. Okay, so you get it. You have the knowledge. Now what? Well, now it's time for action. Let's get into your 4-step fix. This is your battle plan, and you can start using it like today. Here we go. Step 1. Pull your credit reports and check for errors. You would be shocked. About 1 in 5 reports has a mistake that could be costing you points. Step 2. Look at all your credit cards and attack the one with the highest utilization ratio first. Put every extra cent there. That's going to give you the fastest boost. Step 3. This one's simple but crucial. Pay every single bill on time. No exceptions. And finally, step 4. Just for a while, stop applying for new credit. Give your score some breathing room to recover. And if you need a little extra motivation for that whole pay on time thing, just let this sink in for a second. A single 30-day late payment can knock an excellent credit score down by over 100 points. Just one. That mistake can stay on your report, haunting you for 7 years. It is without a doubt the single most damaging thing you can do to your score. Okay, let's wrap this up by talking about why any of this actually matters. Why should you go through all this trouble? Because this isn't just about chasing some random number. It's about what that number unlocks for you in the real world. It's about saving real, cold, hard cash. I mean, seriously, think about it. A better score gets you lower interest rates on everything: car loans, credit cards, and the big one, mortgages. Over the life of a 30-year mortgage, having a great score versus just a fair one can literally save you tens of thousands of dollars. That's money that stays in your pocket, not the bank's. That's real financial freedom. I love this analogy. Think of your credit score like a garden. It's not something you fix once and then forget about. You have to tend to it. You water it by paying your bills on time, and you have to pull the weeds. And the biggest, ugliest, most destructive weed in that entire garden is high utilization debt. You get that weed out by the roots, and everything else in your financial life has a chance to grow. So, there you have it. You know the code. You know about the 5 pillars, you know the secret of that utilization ratio, and now you have a 4-step plan to take back control. The steps aren't complicated, but you do have to take them. So what's it going to be? What's the first weed you're going to pull from your garden? What's the one thing you're going to do today to start building that better financial future?